Okay, welcome back. I'm going to discuss one questions, yeah, from your tutorial. That is question 25, exercise 25.7. Exercise 25.7. So Yara Limited and River Limited are two family-owned flax producing companies in Queensland. Yara Limited is owned by Jones family and the Smith family own River Limited. The Jones family has only one son, okay, and he is engaged to be married to a daughter of Smith's family. So they are, so they are very lucky then, yeah. Because the son is currently managing River Limited, it's a proposed that after the wedding, not only the business wedding, yeah, but their son and daughter also get married. He should manage both company. As a result, it is agreed that by the two families that Yara Limited would take over the net asset of River Limited. So Yara is the acquirer, River Limited is the acquiree. So you are given this information, this financial statement for River Limited. This is the accounting balance. The carrying amount is the accounting balance. And this is the fair value of these assets. So let's go one by one. The cash is 10,000. Certainly the value will be 10,000. Yeah. For account receivable, the carrying amount is 70,000. But if you look at the fair value, is only 62,500. Maybe if you discount it or factor it, you'll only get 62,500. The land in the book value and the carrying amount is 310,000, but the fair value is much higher, 420,000. So we are going to use this 420,000 value. The building 265, the fair value is much higher, 275. So we're going to use 275. The farm equipment, yeah, 182 is the fair value. The irrigation equipment, yeah, the fair value is 112,500, and the vehicles, the fair value is 86,000. So for all the assets, you're going to use the fair values, yeah, the fair values. Okay, how many assets do you have? 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7, including cash, Okay. And then the account payable for the liability is 40,000, and the loan from Tree Valley Bank, that is 40,000. So this is the liabilities. So what are the arrangement? The arrangement is Yara Limited is to acquire all assets of River Limited except for cash. So Yara is going to acquire the 6 classes of asset: account receivable, land, building, farm equipment, irrigation equipment, and vehicle, not this cash 10,000. So you're not going to take this cash 10,000. Okay. Having a carrying amount and one of the vehicles, except cash, and one of the vehicles with carrying amount 22,500 and the fair value is 24,000. So for the vehicles, we have vehicles here, 80,000 and 66,000, 86,000, but you're going to take over. There's only one vehicle that the fair value is 24,000. Assume all liability except for loan for the traveler is then to go into liquidations. Okay. And assume all the liability except for loan. So we're going to take over this 40,000. Okay. River Limited is then go into liquidation. There's no more River Limited, and the vehicle is to be transferred to Mr. and Mrs. Smith. Mr. and Mrs. Smith. Okay. the balance of the vehicle. Maybe they have 3 vehicles, so that the remaining 2 will be transferred to Mr. and Mrs. Smith. Okay. Next, Yara Limited is to supply sufficient cash to enable the debt to the Trevally Bank to be paid off. You're going to pay the Trevally Bank, and to cover the liquidation cost. Cost of liquidation 2,750. So this is the liquidation cost. And it will also give 75,000 to be distributed to Mr. Smith and Mrs. Smith to help pay the cost of the wedding. So this is another cost you're going to pay, that is 75,000. 75,000 for the wedding. But this is the part of the agreement. So the consideration transfer also include 75,000. Yara Limited is also to give a piece of its own prime land to River Limited. So Yara also give land, a piece of land to Mr. and Mrs. Smith. Okay. The price of land in question has carrying amount of 40,000 and a fair value of 160,000. Okay. This one will be given to any offspring of the forthcoming marriage. Yeah. Okay. The one is 110,000. 110,000. Okay. Yara is also going to issue 50,000 shares, okay, whereby the fair value per share is $14. So you need to multiply 50 multiplied by 14 to be distributed via River Limited to be soon to be married daughter, that is Mr. and to be married daughter of Mr. and Mrs. Smith. Okay. That is currently shareholders of River Limited. So on top of that, the takeover proceeded as the per agreement, with Yara Limited incurring additional costs 12,500 and the share issue cost of 9,000. So this is additional cost incurred, for regarding to the agreement. So some of these costs will go as an expense, and what a part of it we can minus from the share, the purchase considerations, the share issue cost. So you are required to prepare the acquisition analysis and the journal entry to record the acquisition of River Limited in the record of Yara Limited. So how are you going to do this? You're going to prepare the acquisition analysis. Can any one of you help me to determine what is the fair value of asset first? The fair value of asset. Please take your time to determine the fair value of identifiable net assets. Okay, so first we need to determine what are the assets acquired by Yara Limited. Okay. Which measurement we are going to use? Certainly, we're not going to use these assets. We're not going to use the carrying amount. We're not going to use this. We're going to use the fair value. Okay. Cash will not be acquired. We're not going to get this cash. Account receivable, yes, 62,500. Land, 420,000. Building, 275. Farm equipment, yes, 180,000, 82,000. Irrigation equipment is 112,500. However, for vehicles, we're not going to have all the vehicle, because we're going to give Mr. and Mrs. Smith a vehicle worth 24,000. So we're going to minus this 24,000. So this will be your assets. This will be your asset. How many assets? 6 assets. 1, 2, 3, 4, 5, 6 classes of asset. And then for liability, we are going to assume this liability. We're going to take over this liability 40,000. So total assets minus total liability. So these are the items that the items that we're going to acquire. Yeah. 1, 2, 3, 4, 5. Yeah. 6. Another one, liability, we're going to minus 40,000. So this is our fair value of identifiable net assets. The first term. Okay. Second, we're going to determine the consideration transferred. I can see there are many means, there are many process involved. It involves shares, involve cash, involve land. Let's do one by one here. The first one down here is about transfer or issuance of 50,000 shares, where the value of this share currently is $14 per share. So Mr. and Mrs. Smith will receive share 50,000 and then multiply by $14. So the value of that share is 700,000. So this is the consideration transferred to Mr. and Mrs. Smith. Okay. Apart from that is about the cash, 240,000. The cash 240,000. Yara Limited is to supply sufficient cash to enable the debt of Triveni Bank to be paid off and cover liquidation costs of 2750 and also 75,000 to be distributed to Mr. and Mrs. Smith. So let us check the liability. If you notice, this liability, this amount of liability will be paid by Yara. So Yara going to pay this 240,000. So that is one important element there, 240,000. Liquidation cost is 2750. Okay, it's clearly stated here. The liquidation cost is 2750. So this is part of the deal. And you're going to give them 75,000. You're going to give them 75,000. Yeah? Including this 10,000 here. 10,000 here. All right. 10,000. So what is the real amount that you give? Actually is 65,000. This is 75,000, including that 10,000. So, or the payment should be 65,000. Yeah, you're giving them 75,000, including the 10,000 from their account. So the net should be 65,000. So that's why in terms of cash, they will receive 307,750. 307,750. And then a piece of land. This is a piece of land. Okay. That they're going to give Mr. and they're going to give to the offspring, okay, of the forthcoming marriage. This is conditional there. They're going to give this land to maybe to their granddaughter or grandson, sure, yeah, or yeah. The piece of land has a carrying amount of 40,000 and the fair value of 110,000. So this will be another 110,000 piece of land of 110,000. So this is the total consideration transferred. There is 1117750. The fair value of identifiable net asset is 10744. This is amount received, transferred to Mr. and Mrs. Smith. 1117750. So is greater than the fair value of identifiable net asset. So this is the fair value. So this is, sorry, consideration transferred minus the fair value of identifiable net asset. So this gives you goodwill of 43750. What happened to this other amount here? Other amounts, for example, any incidental cost 12,500 and issuance of share 9,000, that will be recorded as your expense. That will be recorded as your expense. This one is your expense, 12,500. This will go to your cash. Debit acquisition expense, 12,500, and credit your cash, 12,500. For the cost of issuing the share, it can be offset to your share capital accounts. So debit the share capital, credit the cash. Okay. So what will be the journal entry? The journal entry will be like this. Yeah. In Yara books, we're going to debit land 70,000 and we're going to put the revaluation over that 70,000. Revaluation land Yara 70,000. This is the regarding this asset that you're going to give to the offspring. Yeah. Okay. And then for other asset, you have account receivable, land, building, farm irrigation, farm equipment, irrigation equipment, vehicle. So all these are your assets. From the purchase, from the acquisition analysis. And then this is your goodwill. Sorry, this is your liability. This is the liability. This is the assets. This is liability. And the different here, this is the goodwill that you determine, goodwill. And the balance will be your consideration transfer. Yeah. So this is the journal entry. This is the journal entries. Okay, the journal entries. Okay, any questions? So that is the process. Start by doing this acquisition analysis, determine the fair value of assets, determine the fair value of liabilities, determine the fair value of identifiable net assets, and then determine this is step number 1. Step number 2 is identify or determine, calculate the consideration transferred from the questions, and then compare your fair value of identifiable net asset with consideration transferred. Check whether you will get goodwill or gain on bargain purchase. Compare between number 1 and number 2. And then you do your records. Normally the exam question will ask you on how to record the acquisitions, yeah, on the date of acquisition. So you have several components. The first one is your asset. This is number 1. Then include your liability. Number 3 is your goodwill or bargain purchase. And number 4 will be your consideration transferred in one journal entries. One journal entries, yeah? One journal entries. Any question? Yeah, I hope every one of you can follow this.